Good morning and welcome to the December 2022 UCLA Anderson Forecast Conference, where we're going to talk about recession or no recession, and we're going to be talking about digital currency and cryptocurrency. So we have a really exciting program today, and with me up here is our forecast team. We have Ed Leamer. Ed has been here at UCLA for a while and mentored many students and had many years as my predecessor as the director of the UCLA Anderson Forecast. William Yu, who it's okay to say that you've been here 11 years, right? And William came to us from teaching in Minnesota and graduated with his PhD from the University of Washington. And Leo Feller, who leads our US forecast team. Leo graduated from Brown University, and after a stint with Johns Hopkins and Boston Consulting Group and Cornerstone, joined us here at the Forecast. We have and I didn't introduce myself, I'm the faculty director of the UCLA Anderson Forecast. I'm Jerry Nicholsberg, and I'm going to be your Master of Ceremonies today. We have the first part of our program. We're going to be talking about the U.S. economic outlook and the California economic outlook. We're going to start with Ed, and Ed is going to talk about recession and how do you understand in a data-based way when we're going to have a turning point in the economy. And that's really the hardest job that we have as forecasters, or anyone has as forecasters, is where are the turning points. So Ed's going to show you how we think about that. That leads us to something that is going to be different from what we usually do. Usually we'll give you a forecast and talk about the risks. Today we're going to give you two forecasts, and then kind of at the end of the forecast program, talk about how you might think about those two and compare them. And we're doing that because there's a great deal of uncertainty in today's data, because in this post-pandemic world, things really are different. Ed's going to show you about that. Then Leo will follow with the US forecast, tracing out what those two scenarios look like. That's going to flow down to the California forecast, and I'll go through that, and then we'll try and pull that together. We'll have a little time for Q&A. Then we'll take a break. Then we have a really great program on digital currency and on cryptocurrency. We had to kind of call an audible yesterday, so your program's not exactly correct. Two of our speakers are unfortunately unable to make it today, but fortunately the bench is very deep, and so Arif is going to do a presentation from the IMF's view, International Monetary Fund's view, on central bank digital currency. And we'll move from there right into our panel to talk about cryptocurrency, what's happening and what might happen and what kind of that landscape is. The other person who unfortunately can't be with us today is Laurie Sentikian, who is the faculty director of the Fink Institute for Finance here at UCLA. So I'm going to be stepping in on that and moderating the panel. Before we get started, first of all, would like to thank the Fink Institute, Laurie, and all the great people there. We're partnering with them in this conference. And secondly, what I'd like to do is thank Steve Gordon and Dick Simon for their special support of the forecast with respect to the work that we do in real estate. And thank Edison International and Southern California Edison for their support of our Forecast Fellows program, a program that provides pathways for students from underserved communities into graduate school. And we're partnering with Cal State Dominguez Hills in that regard. Next, what I'd like to do is thank our sponsors. We are a public institution. We couldn't put on these programs without the help of our sponsors, And so we're very grateful for their support. Our principal sponsor today is RSM. Our platinum sponsors are the law firm of Allen Matkins, Cathay Bank, Clark Construction, Leap Development, and University Credit Union. And by the way, University Credit Union actually started here on the campus of UCLA. So it's really a pleasure to be partnering with them. And at the gold level, Avenue Insights and Analytics, Bank of California, California Bank and Trust, California Steel Industries, Venture Forward by GoDaddy, Pacific Western Bank, Robert Half, and United Airlines. At the silver level, Hathaway Dinwiddie, Scott Work North America, Union Bank, the private bank, and Valley Bank. And at the bronze level, Dub Value Creation, EY, HDR, Hanmi Bank, InstaWork, Marsh McClellan Agency. And at the Bruin level, Gerber Kawasaki Wealth and Investment Management. And our academic sponsor, of course, is UCLA Extension. Many thanks to all of our sponsors. And I think as we are about to begin a new year, if you didn't hear your company's name on here, let us know. We can fix that. And we'd be happy to fix that. And finally, before we jump into our program, I want to thank two people who are on the staff of the UCLA Anderson Forecast, Seth Katz and George Lee. These folks work incredibly hard to make this a great program. Things that you don't see, but it is really valuable in the programs that we put on. So thank you to our staff. And with that, I'm going to turn it over to Professor Ed Leamer to talk about how we think about these turning points and what does the data tell us.
Okay, thank you very much. I guess you can all hear me. I'm not going to give the forecast. We're going to make the forecast together. So I want you to see how it all operates, and you can decide whether I've got it right or not. And the first thing we're going to look at is the slope of the yield curve, which is the interest rate on 10-year Treasury minus the rate on the 3-month Treasury. Normally, you get paid more, a higher interest rate on a 10-year, but occasionally you get this inverted yield curve in which the 10-year yield is less than the 3-month yield, which is exactly the way it is right now. And an inverted yield curve is usually thought of as a predictor of recession. So you're going to see in this image the yield curves that have occurred in 7 expansions historically. You look at the horizontal axis that says 36, 24, 12. That's the months before the next recession. I'm going to stick in one episode. That's the episode that ends in 1957, August, where the circle is around that legend at the bottom. And that's the yield curve that occurred in those 36 months back in the 50s. And you can see that the yield curve was fairly steep, meaning that the spread was above 1% in 3 years before the recession. And then it's more like 0.5% in the year before recession, and then maybe a little lower in the year before recessions. So it's already suggesting that a flat or inverted yield curve might indicate that a recession is coming. But that's just one of 7 episodes. And I'm now going to stick in the other episodes. That's the 1969 event. One thing that's interesting is at the far left, there's an inverted yield curve, meaning a negative slope of the yield curve 3 years before 1969. That was in 66, where the bond market was flashing out warnings. Those warnings were offset by the ramp up by the Department of Defense spending on the Vietnam War. So the recession that was being signaled by the bond market didn't actually occur. But I would say the warning was legitimate, even though it didn't produce a recession. It didn't create a recession as a following. But again, you see the yield curve inverting in the 3rd month before. That's the Burns episode, where Arthur Burns was the chair of the Federal Reserve over here on the right and created a deeply inverted yield curve of more than a full percentage point difference between the 10-year Treasury and the 3-month. That's the Volcker era. ending in 1980 in January. And those black dots indicate the period of time when Volcker was actually chairman of the Federal Reserve. He didn't take over until the end of that episode. But he too, like Arthur Burns, created a deeply inverted yield curve immediately before they had a recession. That's the 1990 event. And I don't know if you can see it, but it never got inverted. So that's a case where we had a recession, one step beyond the right edge, without having an inverted yield curve indicate that the recession was coming. That's the 2001, and that's the latest one was 2007. You can see there the yield curve occurred a full year ahead of time. It wasn't in the immediate year before recession, but a full year. And then as a way of summarizing it, that's the mean of all those 36 observations. Every mean by month by month. You can see the mean is indeed getting flatter and flatter until the very end. It turns negative about 6 months out, and then it starts to improve. The reason is the Fed is saying, oh my God, we made a mistake. We've got to reverse this outcome and start raising interest rates again. But until then, the Fed is the one that's in control of the yield curve. So then the question is, what do we do with the most recent data? How do we insert that into this image? And we're going to take the 12 months, we're going to put it where it belongs most compellingly. That's your job. I'm going to do it for myself. And there it is right there. That's the little diamonds. And you can see there's really two kinds of episodes. Whoops. Oh, here we go. There's the last 5 months have had a pretty flat yield curve, and it ends in November with an inverted yield curve. That's the last little diamond on the right-hand side there, or triangle rather, I'm sorry. But it's also an earlier period of time in which the yield curve was rather steep. And if you look at this, that incredible drop in the slope of the yield curve doesn't at all well conform with the means. The means are kind of smoothly moving down to the right. But if you let your eye move a little to the right of where where those triangles are, you'll see the orange. That's the Volcker era. So let's eliminate everything and just use the Volcker era and see what that looks like. So this same image, and that's the Volcker at the end where he gave us a deeply inverted yield curve. That's where my algorithm wants to place that 12 months. But you can see you can move it a little bit to the right, and then it would replicate the Volcker era. So if we use that as evidence about where we are now, we would say, well, Volcker had a period of quietness where he didn't feel he needed to create a terribly inverted yield curve. He's waiting for the inflation problem to cure itself. And that could be what happens now, where the Fed says, look, we've been raising these interest rates crazy. Let's give a little time out and see what matters. But for Volcker, the inflation got totally out of control, so he had to create a terribly inverted yield curve. That's just my way of saying, I think I've got the placement about right. This is an algorithm that does the placement. It's a little bit to the left of the Volcker era, but not so much. So that placement is done econometrically, and it produces an outcome and a probabilistic allocation of that last month of the most recent 12 data among those 36 options. And another day I'll give a lecture about how this all works out, but that algorithm produces a number of a 71%, 71% chance that those 12 months ended in the 16th month before the next recession. In other words, it says the recession is probably more than a year away. And that's being pulled back by the fact that we've got those pretty high, pretty steep yield curve in the first 6 or 7 months of the last 12. But if you just focus on the 2 months, then it says there's virtually a 30% chance that we're in the last 6 months of the data. And the reason is those last two months, here's the picture again, the last 2 months at the end are when the inverted yield curve occurred. So that's ringing out a very loud alarm bells, but the earlier months say probably a year later. Of because the yield curve is so steep at that point. And then, so this is the summary of what my algorithm produces. It produces probabilities for every 6 months, the most recent 6 months, the next 6 months, and there are 6 of them in the 3-year interval. And then I do it for, based on the 1-month data alone, and it says there's a 41% chance that we're in the second 6 month away from the recession, but a 38% chance that we're in the last 6 months of the expansion, that the recession is imminent, or pretty high probability that we're late. But if you move up to 2 months, it says 57% chance that we're in the last 6 months. But if you move up to 6 months, you get 69% that we're a full year or more away from the recession. And the reason is, once you add that 6 months, you add the old data in. So I'm just trying to give you a sense that there are kind of 2 outcomes implicit in that yield curve. The outcome that depends on the steep yield curve that was 6 to 12 months ago, and then the outcome that the Fed has induced with the inverted yield curve. And then if you use a full 12 months, it says it's an 80% chance that we're more than 1 year away from the recession. So that's that. What about inflation? So here you have the image of inflation. I don't know if there's a period of high inflation, and then it gets softened. There's two episodes in this event too. That's one of the, my algorithm is sort of indifferent between placing it where you see it here and placing it a little bit farther to the right. But the essential point again is there's 2 kinds of episodes. And if you look at these, the graph, all these inflation periods, you don't see a reversal in inflation rate. It looks like you got to get to the end when the inflation occurs in order to have any kind of control over inflation. If you look at the 1970s, the so-called stagflation period, you'll see that the Fed had no impact on inflation until unemployment rose. So the takeaway there is the Fed doesn't matter with its higher interest rates. It might have an impact on your purchase of homes and cars, but it doesn't cure the inflation problem until you put people out of work. And then you get a cure of inflation. Anyway, so here's the unemployment rate. The thing is that at the far right, the unemployment rate is nice and low and pretty steady. So it looks like the labor market is doing great. And that's a symptom that you're at the end of the 3 years. Earlier, the unemployment rate tends to fall. Over here at the average is falling. Those little circles that represent the average, they're falling until you get over here on the right, and then it's flat. So the low unemployment rate that we're having now, oh, by the way, there's a little tail. I got those triangles, but I have some squares. The squares represent the actual data, but that's the COVID-19 period. And COVID-19 has destroyed the historical meaning of what we have. So I eliminated COVID-19 in order to produce the unemployment triangles. And that says that a recession is imminent, only 6 months away. Here's housing starts. Housing starts are issuing a big alarm. We're having declining housing starts, which is a very clear indicator that you're in the last 6 months of or the last year of the expansion. Very clear statement about that. You all agree with that picture? And then the other one is average weekly hours in manufacturing. The thing about the manufacturing sector is when demand is weak, they don't initially fire workers, they cut down the overtime hours. So you can see this is average hours per week, and the vertical scale is 40 hours, 41 hours. So over here, we started the last year, that's the triangles. We started this last year with a lot of overtime in manufacturing, with an average work week of 41.5 hours. And then that's been declining ever since, a symptom of weakness in manufacturing. So that's ringing out very loud alarm bells about the immediacy of the recession. Housing and the 2 Main Street items, which are housing and manufacturing, they seem like they're in the recession already. They're receding. The question is whether that's going to affect the rest of the economy, and if so, when is that going to occur? So here's my forecast, mix them all together. And on the left-hand side, that's the spread. That's the data analysis based on the spread. Inflation, unemployment starts in housing and manufacturing. And then on the far right is combining them all into one. Okay, so let's start on the tall greens. Those are the data series that are signaling that we're within 6 months of the next recession. And we just went through them. That's inflation, housing starts, and hours in manufacturing. Green means 6 months away. And those time series are all supporting the conclusion that's only 6 months away. but the two that think differently are the spread, which very strongly says we've got a whole year waiting to occur. And you're not going to have a recession until a full year ends. And then unemployment says maybe we're in 6 months or maybe we're about a year away, but it puts a significant probability on that as well. So we've seen the pictures. They're kind of a mixed message. That's why it's logical, it seems to me, when Leo is going to talk about alternative scenarios, because we don't know really which way this is all going to go. But if you use the combined rate, it says it's the yield curve that dominates. And we're going to have to talk about econometrically, how can that possibly be? And how can the combined analysis ignore the unemployment and starts in housing and manufacturing? We can talk about that later on, and that's the way the algorithm works, and it produces that conclusion. But the things that I worry about are the Main Street variables, which are housing and manufacturing. And if this is an image of housing starts, the log of housing starts, so the numbers 7.2 and 7.6, that's like the log of 1.5 million. That's the black lines that are going up and down the housing starts. And that blue line represents the rate of growth of population over the last 3 years, the people who need to have homes built in order to house them. And that's a nice smooth series. And you can see the overbuilding, underbuilding. There was a period of terrible overbuilding in the early 2000s compared to population needs, but that was more or less completely offset, and more than offset by the big decline in housing starts after that. So we've had what looks like overbuilding, but not a whole lot. So the housing sector doesn't have the terrible overbuilding, it doesn't have the financial sector problems of all those subprime loans that went to individuals who couldn't afford it. So it doesn't seem like you're going to have a very serious housing crisis, is what I would say. And then what about manufacturing? Well, this shows you the share of our workforce in manufacturing, which back in the 60s was something like 30 or 35%. Now it's only 8%. This, by the way, is my explanation of why we're having an attack on our democracy, because we built our democracy in our factories. That's where you had a good job if you had a high school education. And lots of communities were very reliant on manufacturing. And we've let all those things disappear without any concern about the communities that were left behind. And those communities are really annoyed with, especially the Democrats. But with manufacturing only 8% of the workforce, that couldn't mean a big recession, could it? So although housing and manufacturing are signaling a problem, it's not a really deep problem. So I think the Fed's rapid inversion of the yield curve says we're going to have a recession in about a year. It looks like Volcker choices. We'll see how Jerome Powell responds, whether he follows the Volcker rules, Volcker choices closely. The COVID-19 has confused the use of the unemployment data, but to get rid of that stuff, it says we're in a big problem. Housing is a problem, and manufacturing as well. So the conclusion is a kind of bivariate outcome, but the latest news in the papers is all about the tech sector laying off workers. So I wondered, what about if I create my image that shows what the tech sector is doing, which is this image. This is the information sector. And you should immediately think, take a look at this. Is this totally unlike what you've seen before? Because these are totally flat. The jobs in the information sector are completely flat. So this is not an indicator of a recession to occur, at least if you look historically. But Leo asked me yesterday, proposed implicitly the point that looking backward, that's the industrial age. Looking forward, that's the post-industrial age. And that means that the things that we see in the past are not necessarily a good indicator of what's going to happen in the future. It could be that the cycle would be driven in the future by the tech sector, not by housing and manufacturing. We don't have enough data yet to answer that as a possibility, but certainly it seems like a possibility. So in conclusion, the future remains hard to see. Thank you for listening.
Well, good morning. So given that the future remains hard to see, we are going to present you two scenarios, and then Jerry is going to summarize some probabilities on these scenarios. So the two scenarios are Goldilocks or bust. And the Goldilocks is a reference to David Schulman, who wrote this 1992 article called The Goldilocks Economy. So if you remember Goldilocks and the Three Bears, right, there's a just right condition that causes us not to have a recession. Or the question is, well, will we actually have a recession? So let me start off with why we have so much uncertainty. And that stems from the Federal Reserve having policy uncertainty, and that leads us to have forecast uncertainty. So this is a quote, a long quote from Chair Jerome Powell from a speech that he gave November 30th. And he says, look, monetary policy affects the economy and inflation with uncertain lags. The full effects of all the monetary tightening that has already happened, it's going to take a while for us to see the effects of that. And so it makes sense to moderate the pace of our rate increases, right? So that suggests this pausing of interest rate increases that Ed had pointed out that also occurred during the Volcker era. The moment that Chair Powell said this, the stock market rallied. Interest rates on bonds fell, right? Financial conditions loosened. And then he also says, given our progress in tightening policy, the timing of that moderation is far less significant than the question of how much further we will need to raise rates to control inflation and the length of time it will be necessary to hold policy at a restrictive level. It is likely that restoring price stability will require holding policy at a restrictive level for some time. History cautions, and again, going back to the charts that Ed shows, history cautions strongly against prematurely loosening policy. The problem is that every time that Fed Chair Jay Powell says, look, we're going to pause and moderate on rate increases, the financial markets automatically loosen financial conditions, right? The interest rates on bonds come down. So any sign of a hopeful pause leads financial conditions to loosen, which is the exact opposite of what the Fed Reserve wants. And so this becomes a game of, do you have to keep increasing interest rates? Not because that's the right thing to do, but because if you pause, the markets suddenly react and loosen financial conditions. So we present two scenarios. In green, we have the no recession scenario. In that scenario, the Fed pauses after increasing rates 50 basis points right now in December. And then that's it, right? That's the end of the tightening cycle. And we get a terminal rate of between 4.25 and 4.5%. We assume that inflation supply constraints are going to ease. We assume that there's going to be some modest increase in unemployment above the natural rate of about 3.9 to 4%. It's enough to ease pressure on inflation, but not enough to force a decline in consumer spending. So in this case, unemployment goes up, but it's a little bit of an increase, and it's not enough to cause consumers to really retrench. What Larry Summers called a Wile E. Coyote moment, where if you remember Wile E. Coyote from Warner Brothers, right, the Wile E. Coyote is running along and then suddenly falls off a cliff, right? So in this scenario, there's no falling off a cliff of consumer spending. So we expect consumer spending to remain resilient, businesses to continue investing because consumers continue to spend, and we don't really expect much more of a decline in home construction. That's the no recession scenario. In red, I'm going to show you the recession scenario. And in this scenario, the Fed has to keep increasing rates up to 5.5 to 5.75%. It reaches that terminal rate in mid-2023. It then pauses, the economy's in a recession, and the Fed starts cutting rates in 2024. We get less easing of inflation naturally in this scenario. Inflation does ease, but that's because the Fed Reserve is forcing higher unemployment, is forcing lower consumer spending, and that's what causes inflation to come down. It doesn't come down on its own. In this scenario, unemployment peaks at about 5%, which is enough to force a decline in consumer spending. So we get a little bit of a Wile E. Coyote moment where consumer spending falls. Consumers cut back, businesses also cut back. We get further declines in home construction and financial conditions, but the recession is relatively mild and short-lived. So let's go through these two scenarios. I'm going to start off showing you annual rates of growth, annualized rates of growth, and that's because this is often what we hear in the press, right? So for those of you who follow the Atlanta Fed's GDP Now, they have this current quarter at a 3.4% annualized rate of growth. The economy is still going strong. We added 263,000 jobs. On an annualized basis, we're still doing pretty well. The recession scenario in red has us declining to about a negative 2.7% annualized rate of growth in the third quarter of 2023. In the green, the no recession scenario, we get a slowdown in growth. We get that one little quarter in Q2 where we get a negative 0.2%. That's basically zero, right? So we're flatlining in the second quarter, and then things pick up again. A different way of showing this is to look at what happens on a year-over-year basis, right? So year-over-year right now, the economy has grown 0.9% above where we were in Q4 of 2021, right? So we got a little bit of growth this year. In the recession scenario, this comes down, and by the end of 2023, we're down 1.2% from where we are today. In the no recession scenario, we're up 1.2% from where we are today, right? So even in the no recession scenario, this isn't a spectacular, year of growth in 2023. 2023 is hard regardless. It's do we grow 1.2% or do we shrink 1.2%? And importantly, the delta between these two scenarios is 2.4%, right? So this is in the but-for world. If we did not have a recession, what would the world have been like? Well, it would have been 2.4% more than in the recession scenario. What does this imply for the levels of GDP, the level of economic activity that we have? So in the no recession scenario, we muddle along, we're kind of moving flat in early 2023, and then growth picks up again. In the recession scenario, economic activity declines. We reach the trough of economic activity at the end of 2023, and then the red and the green line are parallel. We're growing at about the same rate, right? We're kind of closing the gap, but very slowly. Not until the end of our forecast horizon into 2025 and 2026 would it be the case that there's no difference in economic activity between the recession and no recession scenarios. I'm going to show you a few charts. This is showing what happens to consumption, right? Between the recession and no recession scenarios, consumption declines. This is what consumers are doing. Consumers are pulling back in the recession scenario. It's about a 2% drop from where we would have been if a recession had not occurred. But businesses also cut back on investing, right? This is the bigger decline. It's businesses and household investment. That declines by about 4.5% from where we would have been had a recession not occurred. And then in terms of unemployment rates, you can see that in the recession scenario, we peak at about 5%. In the no recession scenario, we peak at about 4.3%. So in both scenarios, we get an increase in unemployment. And in part, that's related to what Jay Powell has referred to as an unhealthily tight labor market, right? Right now, we are at 3.6% on a quarterly basis. We're at 3.7% unemployment as of the November jobs report. This is, according to the Fed Reserve, leading to higher wage growth. And that higher wage growth is feeding into higher inflation. And so the thought is that that 3.6 or 3.7% where we are today is too low of a rate of unemployment. It's such a low rate of unemployment that it's allowing workers to be able to negotiate higher wages, negotiate better benefits, and that is causing prices to increase and be passed on to, in terms of higher prices for consumers. So some of the rebound, some of the increase in the rate of unemployment is just getting back to maybe this natural non-inflationary rate of unemployment, which might be around 3.9 to 4%. We don't really know what the non-inflationary rate is. What we do know is at 3.6%, we have high inflation. And so some of the increase coming back is just to get us to be at a low rate of inflation Maybe we have to go a little bit beyond that to the 4.3% in the no recession scenario to really stamp out inflation. In the recession scenario, we have to go all the way up to 5% to get inflation to come down. The way that this gets accomplished is through the federal funds target rate, right? So the federal funds has its benchmark interest rate. In the no recession scenario, as I mentioned, we get one more increase right now with 50 basis points and then no further increases. That's the terminal rate. We end at about 4.4 to 4.5, or 4.25 to 4.5%. In the no recession scenario, the Fed then holds that rate through the end of 2023, and then it starts bringing rates down in 2024. In the recession scenario, the Fed continues increasing rates, right? This is the yield curve getting more and more inverted that Ed Leamer pointed out. And in this scenario, the Fed takes rates all the way up to 5.5 to 5.75, 5.6 being the midpoint of that. And then because we're in a recession, it abruptly starts cutting rates at the end of 2023, beginning of 2024, and it brings rates down fairly quickly as inflation has come down and as unemployment remains at 5%. So one thing to keep in mind is, can the Fed successfully orchestrate a soft landing of the economy? Right, so let's go all the way back to the 1950s and look at the data. And what you see is that the Fed, 9 out of 12 times, when it increases interest rates, it causes a recession, right? Or it's correlated with a imminent recession that comes right after these rate increases. You can see this on the right-hand side, right? So every shaded gray is a recession that happens. Every red dot is the Fed increasing interest rates, and then we get a recession. There are 9 of those red dots. There are 3 green dots, and those 3 green dots are the Fed increases interest rates, and we don't get a recession in that coming year, right? So if you just look at this, you say, look, 75% chance, 9 out of 12, when the Fed is increasing interest rates as it's doing today, we end up getting a recession if we can look back in history and use history as a guide. There's one additional point, which is not only is the Fed increasing interest rates, this is one of the fastest rates of increase in the benchmark, the Fed Reserve's benchmark rate since 1983. So that's the red line that's going up, and you can see how steeply it's going up. And we expect it to go up faster and the increase to be larger than at any other point in time in roughly the past 40 years, right? So if you just look at history, 75% chance that we're going to get a recession given Fed tightening rates. If you then add on top of it that this is one of the fastest rates of increase that we've had since 1983, that likely makes the chance even higher. But that's just using this one indicator as a guide. And as Ed Leamer pointed out, there's several other factors that we need to consider aside from just the history of Fed hiking to determine whether or not we're likely to have a recession. One of the strong points is that inflation might actually come down more quickly than we think it will, right? And that will be a positive sign. So let me explain this graph. This is a contribution from my colleague, Jerry Nicholsberg. We talk about inflation if we break it out by several different items from what consumers normally buy. So this is CPI inflation. On the right-hand side, we had 7.8% year-over-year total inflation. And all these blue bars are the contribution of individual items to that inflation, that 7.8% inflation. So education goods actually led to a little bit of deflation, right? The price of education goods went down 0.07% year over year over the course of this past year. Alcohol only went up, its contribution to the CPI was 0.04. Alcohol might have gone up a lot in prices, but it's just such a small share of what we consume that it doesn't contribute all that much to the overall inflation. So if you look at this, you say, okay, education, alcohol, motor vehicle parts, water, trash, sewer, keep on moving all the way to the right. And basically, all the way through to medical services, you're still at below 2% year-over-year inflation. What got us to the 7.8? Well, we had really high inflation in things like airfares and rental cars. That's this other transportation component. That contributed about 0.9 percentage points. We had huge inflation in shelter costs, right? 2.25 percentage points of that 7.8 is just housing, rents, shelter. And then we have energy, which is up 1.41% year over year in terms of the contribution to CPI, and then food, which is 1.43, right? If you exclude food and energy, which tend to be very volatile, we're already seeing gas prices come down, we've seen food prices stabilize, we would be at 6% year-over-year inflation. That's still far above the Fed's target. If rents come down, then you're gonna be at about 3% year-over-year inflation, right? If we stop getting inflation in transportation services, airfares, rental cars, then you're right at about 2% year-over-year inflation, even if you have the same amount of inflation in everything else in the economy that we experienced. So a little bit of good news on the housing front, since housing is the biggest component, contributing 2.25 of that 7.8, is that if you look at Zillow, right, for those of you who obsessively consume Zillow and look at what's happening to the prices of your homes, you're probably seeing that the price of your home is coming down, right? And that's unfortunate news for you, given that that's the price of your home. That's good news for the economy, because it means that shelter inflation is likely gonna come down, but it happens with a lag. What we tend to see is that rents come down on Zillow, but then CPI, the measure of shelter cost inflation, comes down subsequently. And that's because even if you don't get increases in rents or rents start coming down, that's for new leases. And it takes a while for that to actually work its way into what you, who signed a lease maybe a year ago, will be paying, or you as a homeowner think that your owner's equivalent rent would be. What would be the rent of renting out your home? So with this, we have our forecast of PCE inflation. You'll see that the red line and the green line are pretty similar, through early 2023, but that's with different assumptions. In the red line, we have higher interest rates to get us to the same inflation as we get with the no recession scenario. So even though we're seeing approximately the same inflation, it takes more effort, higher interest rates, for us to get a similar rate of inflation as in the no recession scenario. And then there's some stickiness in the recession scenario, which is why we have a recession. We kind of come down to 2% rate, but only by 2024. In the no recession scenario, we get to that a little bit sooner, between Q1 and Q2 of 2024, down to the 2% rates of PCE inflation that we're accustomed to. The difference between the two scenarios in housing starts, we've already had a big decline in housing starts. This is new housing construction. You've already seen that in the gray line. What has happened in 2022 is that housing has already started coming down. In the no recession scenario, that's it, right? We stay at this lower level of housing construction through 2023. In the recession scenario, housing comes down even more, right? And we get to about 1.2 to 1.3 million units of new additional homes being built throughout 2023, a steep drop off from the 1.7 million units that we had early in 2022. In terms of home prices, both scenarios are giving a comparatively mild, and I'll show you what that comparatively mild means in a moment, decline in home prices. We get about a 4.6% decline in the no recession scenario, peak to trough, versus 6.3% decline, peak to trough, in the recession scenario. And in part, that's because we haven't overbuilt homes, where you still have a housing shortage throughout much of the US and especially in California. If you contrast this to what happened during the Great Financial Crisis, there you saw a 27% decline in home prices, right? So we're not forecasting anything like the Great Financial Crisis in terms of the housing market bust that we experienced back in 2008, 2009, right? Here we're looking at a decline of about 5% between these two scenarios versus a decline of 27% that we had back in 08, 09. We are forecasting a continued decline in oil prices, a little bit different between the no recession and the recession scenario. The recession scenario is likely to be lower oil prices just because you get lower demand, both in the US and globally. We've already seen oil prices coming down. We're seeing oil prices come down at the pump. This is positive news in terms of disinflation, which is this creates less inflationary pressure for the economy. And then lastly, let me just close by saying that in the grand scheme of recessions that we've had, if you go all the way back to 1950, we're looking at declines in economic output, right? This is real GDP growth, percent change year over year. Every gray shaded bar is going to be a recession. And you can see the depths, how far below the zero do we come in each of these each of these shaded bars. And the answer is that if you look at the red line, our recession scenario, our recession scenario is relatively brief and relatively mild compared to the history of recessions that we have experienced, right? So less severe than the recessions that we had in the 1950s, less severe than the 1975 and the 1980s recession, obviously much less severe than the Great Financial Crisis, much less severe than the pandemic recession, relatively mild and brief in comparison. So with that, let me pass this on to my colleague Jerry, who will talk about California.
Thank you, Leo. There we go. So now let's turn to California. And if you remember that slide that you were just looking at, where Leo was describing these mild recessions that we had in 2001, 1990, that was too soon. Those were mild recessions in the US. They were deep recessions in California. In fact, all 4 of the last recessions were deeper in the state of California than in the nation as a whole. And so the question that I want to ask in looking at both of these scenarios as they flow down into the California forecast is this a recession déjà vu? And the answer is no, because it's not 1990 when we had a huge aerospace contraction here. This is a picture of the cafe out at the Lockheed factory in Burbank. It's not 2001 where we had an implosion in the Bay Area in the dot-com bust. It's not 2008 where we had a collapse in housing, and it's not 2020 where we had the closing of the California economy in a more severe way than you saw closing across the US. So let's explore that, and the way that we want to do that is first to benchmark what's happening in California with the employment data, and then go to tech. Ed referred to tech and all of these layoffs, and you saw the headlines, and is at the end of the party in tech. Tech has been one of the dynamic sectors pushing growth in California over the last 2 decades. And then 3 sectors that are going to be important in this, government, logistics, and construction. And then that will lead to looking at the 2 forecast scenarios as they've flowed into California. So let's begin with employment. What you see in this graph is non-farm jobs, payroll jobs in California. You see the big drop there, which was a 16% drop. That's the 2020 recession, and then a steady recovery. Our data is through October of 2022, and we're now 0.2% above where we were prior to the pandemic-induced recession. So we've recovered all of those jobs in California, but that's only numerically. We have the same number of payroll jobs, slightly more than the same number of payroll jobs as we had in February 2020, but they're in different places. And you see that in this graph here. This is the change by sector in the number of payroll jobs from February 2020 to the October numbers that we have. And all the way over on the right-hand side are 2 sectors that contribute about 175,000 missing jobs. And those are leisure and hospitality, that's the big one there, and then other services, which is a small sector, but had a big loss in the number of jobs. That's personal care services, for example. And on the left-hand side, the sectors that grew fast enough so that numerically we had more payroll jobs are 2 tech sectors. One is professional, scientific, and technical services, and the other, Ed showed you in that graph, information, and then also transportation, warehousing, and utilities. It's mostly transportation and warehousing. That's logistics. And between them, we have healthcare and social services growing in California and all throughout the nation, and administrative services, which is where temps live, and construction. So let's dig into tech first of all. And this is payroll employment, so the same from the same data set in these 2 tech sectors, information and professional, scientific, and technical services. The red is information. The blue is professional, scientific, and technical services. And what you see in this graph is employment there is growing and has been growing. You don't see those tech layoffs here. And so what about those tech layoffs? Well, this is from CNBC, a screenshot, and it says tech layoffs, number of employees let go. There are a lot of, and it's in fact an increasing number, but we didn't see that in the payroll employment numbers. And it says on the tagline, ballooning tech layoffs, not the canary in the coal mine. So, what is happening here? Well, I think a really good example is Twitter. We all know that Twitter laid off or had quits of more than half their employees. So we're talking about maybe 4,000 employees. In the 4,000 to 5,000 employees. In the Bay Area, that amounted to less than 900 people because those employees were laid off all over the world. In Europe and in Asia, it's more than 1,000 people laid off. So the impact on California is not what we saw in 2001, where there was a real concentration of all the activity in the Bay Area. Now it's very much diffuse. And Forbes reported that in the first week after these layoffs, 30% of all those who were laid off were hired by other companies. So how is that happening with all these layoffs? Isn't tech imploding? Well, the question is there money to hire them? And what firms are going under? This is venture capital investment, 2021 on the right-hand side. California is the largest there by far. Then comes New York and Boston. And the next one is Texas. California is 17 times as great as Texas in venture capital in 2021. 2021 was an incredibly explosive year in terms of venture capital investment. It went off trend by about a factor of 2. So 2022, the first half, is on the left-hand side. And again, huge numbers, larger than 2018, larger than 2019, along that exponential trend in terms of investment. And the top one is San Francisco Bay Area, then New York, then Southern California. And if you break that down, what you find is that this money has gone into angel first round and second round. These are companies that are not going to be going for IPOs, not going to be accessing the rest of the financial market for a number of years. That's where the hiring is happening. So they're not so worried about this next year. The firing, if you remember, these are Amazon, Twitter, Meta. These are big companies that grew really fast. They bought a lot of other companies, and now they're consolidating. They're seeing some of the things that they were doing are no longer profitable. That's not 2001, where we overbuilt in equipment and software in Silicon Valley. So that's tech. Let's turn to government. In past recessions, California government has contracted more than other states. We've had these huge deficits. If you recall back to the Governor Davis and Governor Schwarzenegger era with these $40 billion deficits. What you see here is cumulative general fund revenue. So it's cumulative on a fiscal year. So going left to right, it's going to be increasing. And you notice there are 4 lines here, the last 4 complete years. But the last 2 of these, 2020 and 2021, are way and above the previous 2. Those were record years. And if you look over here, a little hard to see, so I'll put an arrow there. That's where we are today in the current fiscal year. And it looks like it's very close to that banner year of 2021. In fact, the difference is only $4.6 billion. And if one goes to the accounts for state government, you find that in the 3 rainy day funds, plus the carryover, the surplus from that big year 2021, there's $50 billion available, not counting where money could be found elsewhere, such as in borrowing. And the Legislative Analyst's Office said the worst this could be, which is worse than our recession scenario, is a $25 billion hit to general fund revenues, more than enough put away in rainy day funds to cover that. So state government is in good shape. Local governments that rely principally on property taxes are not going to be impacted by a recession, even though home prices are coming down. The vast majority of homes in California are assessed at values less than market value. And since CPI was above 2%, those property tax bills are going up by 2%. Right? So local governments are also in good shape. And compared to the rest of the US, probably California is in better shape and will have a much more moderate decline, if a decline at all, in the government sector. So long as all of that money in 2021 didn't go for hiring and sort of expansive hiring relative to the rest of the US. And in this chart, we benchmark payroll in state and local government in the US outside of California. That is the blue line. The orange line is in California. There's seasonality here due to education hiring, due to the school year. But you notice California is not much different in this regard than the rest of the US. So government seems to be probably more moderate than the US in both scenarios that we have. What about logistics? That was that big one, remember, in the first chart, the sectoral chart. This is seaport traffic. The red is exports, and exports are down because of recessions in the rest of the world. The blue is imports, and these are measured in containers. And you notice that it's kind of up and down on the end. It's still record levels, but it's been declining. The reason it's been declining is two labor actions. One is the negotiations with the dock workers at the ports. And that's still going on. The second, which seems to be resolved this last week, is a railroad strike. So in one case, you can't get your containers off the ship if there's a strike. In the other, you get your containers off the ship, but you can't send it to Atlanta or Pittsburgh or Chicago or wherever the containers were going. So what do shippers do? They try and diversify their portfolio, mitigate the risk, and they've been sending ships through the Panama Canal into East Coast ports. And the port of New York and New Jersey now looks like what we used to see a year ago at the ports of Los Angeles and Long Beach. So when we think about this, that's a more expensive way to ship through the Panama Canal, through the Gulf, to these ports. You also have to worry in part of the year about hurricanes and the like. And so that traffic is going to come back, maybe not all of it, but a lot of it is going to come back as we move through 2023 and these labor issues are resolved. And that means that even though there's going to be some contraction in consumption in one of our scenarios, at the ports, they're going to see an increase in traffic. So logistics is going to be in pretty good shape. And that feeds into industrial space and into construction. So this is the Alan Macken's UCLA Anderson Forecast survey of industrial space developer sentiment. And the dashed line there is at 50. Above 50 is optimism. And you see across the 5 markets that we survey, developers are optimistic. They're so optimistic that they have plans for building even more warehouse space this next year. And that's going to be a demand for construction workers. And so this is kind of feeding into that 2008 collapse in construction. It doesn't look like it here. Okay? Well, what about housing? So this is California median home price as of October 2022. On the left-hand side, it's down 8.7%. Some of that is compositional because it's median, but not all of it. And on the right-hand side, those are home sales, and they've kind of collapsed, right? And they look like a recession collapse. But as Leo pointed out, the Federal Reserve raised interest rates very rapidly, and home mortgage rates went up to about 7.19 for 30-year fixed. Now they're down, and they're down below 7%. But what's happening here in these markets is sellers know they're going to have to lower their price with the higher interest rates, but they don't want to lower it too much. Buyers know that price is coming down, but they don't want to be stuck with too high a price, so they're staying away from the market, and you have price discovery going on. And so are we going to have a contraction in home building. Well, again, in our survey, we survey developers of multifamily housing, and you see they are uniformly optimistic, and they're doubling down this year on building more multifamily housing. Now, there may be an issue as we go forward with financing, but when we're right in the middle of the winter 2023 survey, and they're saying, no, we know all of this that we all have been talking about, and we're still doubling down on this. And you can see that looking cross-sectionally at the US. So these are states in the South and West, and the blue here is year over year for the first 9 months, new building permits. And you see that some states had an increase over the first 9 months, looking left to right, and a lot of the blues are a contraction. That means fewer homes, fewer building permits were issued. The red is the last 3 months of those first 9 months, and almost everything turns red. Over on the right-hand side, Utah, Tennessee, and Colorado. But on the left-hand side, there are 2 states that have actually seen an increase in building both over the 9 months, but also the last 3 months. And the one on the far left is California, and then the next one is Texas. So again, we're seeing a much milder impact. Part of that is the multifamily housing. Part of it is changed products like duplexes and ADUs that are now available in California and were not before. And so again, we're not going to see as much of an impact of these high interest rates, these high mortgage rates on home construction in California as we see on average in the US as a whole. And that brings me to manufacturing, and Ed talked about manufacturing, and I just want to illustrate this with one of the subsectors of manufacturing, the one that imploded in 1990 and gave California a steep recession that lasted for 4 years. The left-hand side is a picture of the B-21 bomber that was just unveiled this week. It is a minimum $80 billion manufacturing contract, and it's going to be in Palmdale here in Los Angeles County. And the right-hand side is a Falcon 9 heavy launch out of Vandenberg. Space and defense are sectors where we're seeing increased demand, and that's going to help mitigate the impact of the recession on California, because California is disproportionately heavy in those kinds of activities. So that brings us to some numbers on the forecast, and this is employment growth on the top. Recession is R, no recession, no R. And employment growth, we have it in the recession scenario on average for next year only at 0.5%, basically zero. During the middle of the year, there is a decline in employment, so it goes negative, but the last quarter brings it back to slightly positive. And then in the no recession, employment growth slows to 1.1%, but it doesn't go negative. And then the unemployment rate, we've got 4.4%, but it actually in the middle of next year hits 5%. And the unemployment rate in the no recession averages at 4%. And then in housing, we get some decline in housing, but pretty moderate. So new construction going down to 116 and then up to 135. These are thousands of units of building. And in the no recession, pretty similar in 2023, but then up to 142,000 new units in 2024. And then finally, real personal income. You get the big drop this year, both because of the end of transfers, but also in what we saw in the state government numbers, the decline in the NASDAQ, and so you don't have those IPOs and the like that are boosting in the state real personal income. It declines in 2023 in the recession scenario. It's basically zero in the non-recession scenario, and then grows in 2024. So that's sort of a quick overview of California. The summary is what's happening in California today says it's not the past 4 recessions. In fact, in either of these scenarios, expect California to have a more moderate impact of these high interest rates than the rest of the nation. But that brings us to the question. We've given you two scenarios in these three presentations. Which one? How do we judge? And so we asked these five people. David Schulman's not here today, and said, give us your best guess as to which one, and couch it in terms of probabilities. And the answer that we came up with by averaging them is 54% chance that the recession scenario is going to be the path that will be followed, and 46% that it'll be sometime after 12 months. And keep in mind, the recession scenario means a recession starts in the second quarter, sometime in the second quarter of 2023. It doesn't mean, so if the vote is for that recession scenario, it's for that, and not that there will be a recession maybe starting in the fourth quarter or in the first quarter of 2024. But those are our two, and this kind of hopefully gives you a guide that as the data comes in, as 2023 starts to unfold, you can sort of judge for yourself, well, which one of these trajectories is the US and California economy going to be on? And you can make your decisions based on that sort of updating dynamically. So that's where we are at. There's lots of uncertainty. Hopefully we have given you something of a guide. And so that finishes the California and the summary presentation. Thank you. And now we have time for some questions. So we have an audience here, and we have a virtual audience. The people who braved LA traffic to come here, you get first crack at the questions. Yes?
Heard a lot in the press, and I'm a banker, we have a lot of clients, that the amount of inventory that retailers and suppliers have is out of control. How do you see that factoring into this decision? We have had clients or suppliers who orders were placed in the spring and summer, and Target, Walmart, Costco said, I don't want it, keep it in your warehouse. How's that going to impact
Go ahead.
these scenarios?
I think we are already in a goods recession, which is in terms of durable goods, non-durable goods, consumers are already pulling back. So we've already seen declines there. But that's compensated for by an increase in services. So over the course of this past year, we've seen consumers pulling back on how much stuff they're buying. But in exchange, they're going out to restaurants, they're traveling, they're consuming entertainment, and that's mitigating some of the recession. So this is already baked in here, which is a decline in goods consumption. Some of this was going to happen anyway because we were so far above trend in how much people were consuming in goods. And as people were able to go out and go into work more often, travel more often, it was almost natural that there was going to be this substitution from goods to services. So already part of this, but to your point, important to keep in mind that we are already, from the perspective of declining economic activity, in a goods recession.
I think one of the things that you saw in the ports data, if you remember on the right-hand side, you had a big dip there. And that was a recognition that inventories were already full, and orders had come in with the notion that you needed to get the goods on the shelves in the warehouses, because if you did have a strike, you might not have enough to sell for the holidays. And all those goods are in now for the holidays. We'll see what consumers do in terms of purchasing over the next month.
But I would add, you're talking about not a recession in the United States, but outside where these products are being produced. So the US doesn't make so many of those anymore.
Yeah, I think that's right. The unemployment associated with that has been exported to China and Southeast Asia. Other questions? Yes.
Yes, I'm someone from Korean consulate, and thank you for the invitation. After you, that is some of us. So my question is, in your analysis about the prediction, how much external factors were considered, such as China global economy, conflict in outside world, oil prices, relations between the United States and other countries, how much in your analysis external factors were factored in?
I think the answer, so the question for those who didn't hear it is, there are a lot of external factors, such as international relations, war in Europe, and so on, and how much is that considered in our forecast? And I think the answer is somewhat, but not explicitly modeled. So you saw our oil price forecast, which has to take into account global conditions. Similarly, we have an assumption about prices coming down, particularly goods prices that Leo spoke about, and that embodies an assumption about the easing of zero COVID policies in China, which after the 20th Party Congress we thought was probably not a good assumption, but over the last couple of days, it seems like it actually was a good assumption. So not explicitly modeled, but we do think a lot about those.
So my response is I have to create the images of the impact of oil prices on the recession. We know that was serious back in the 70s and 80s, maybe not so much anymore, but the kind of images I could create, I could do that, but also exports. And that would tie the United States economy in a very clear way to the external sectors.
It's modeled also to the extent that we foresee a decline in the European economy. Right? I think there's a lot more certainty there with what's happening in the UK, with what's happening in Europe, that it's going to be a particularly weak 2023 for Europe. And so that gets embodied in demand for our exports. And that's the way that it's going to impact the US GDP, the US economy. I think the greater uncertainty is within the US, right? What will be the Fed's path? And so there's going to be some reverberations on, as the Fed increases interest rates even more, that affects the value of the US dollar. That's going to affect other global economies. And so that aspect is embodied in our forecast through the channel of the Fed funds rate and what that might do to the US dollar and to imports and exports.
But I would add that I don't think the US historically has had its recessions created from the export sector. They've been grown at home. But it could be different going forward, for sure.
Yeah, and in that regard, there's good news and bad news for California in this. In a strange way, it's good news. I mean, the world is a more dangerous place. And so we are now seeing contracts for additional defense expenditures by other countries. In the recent budget agreement, there is $10 billion for additional exports of military equipment to Taiwan, for example. And that impacts in a positive way employment and income in California. One of the negatives is the harvest this year has been a poor harvest. And through particularly the Port of Oakland, but California's ports, we export agricultural goods, and that's down. Okay, other questions? Do we have any questions from our online audience? Oh, so for those who are within the paywall, we have Slido, and as we go forward, please put your questions in there. So have we answered all of your questions? Yes?
Based on the forecast for a recession, I see that the Fed funds rate may soften, but in terms of it going to 0%, what would it take for that to happen? Would it be international effects, or what would exactly would it take?
For us to go down to a zero lower bound.
So you're asking, what would it take for the Fed to lower the Fed funds rate to 0%? Is that correct? Okay, so that's a good question.
So let me take that. I think if history is any guide, we need to see some kind of systemic financial crisis, right? We need to get some kind of freezing of financial markets that would, scare the Fed into lowering interest rates, so drastically from where they are today to get us back to kind of that zero lower bound level. Given where inflation is, I think it's unlikely that they would do that so quickly. And given that we haven't seen so far, any kind of systemic risk as we had with Bear Stearns and Lehman Brothers, even the collapse of FTX doesn't have some kind of spillover effect more broadly that really rocked the overall financial system. And so right now, it doesn't look like there is an imminent crisis that might necessitate getting back to zero interest rates. And then there's just kind of the bigger picture of investment demand going forward. So one of the things that we haven't mentioned here is that we are seeing a lot of businesses seeking to invest in labor-reducing technology, right? So kiosks, automation. We are having investments in green infrastructure. So more fuel-efficient cars, more energy-powered cars, and energy infrastructure. The same way we had kind of the interstate highway system being built, we're getting proposals for an energy infrastructure being built across the U.S. All of this requires capital, and all of this bids up the rate of interest. And so it's difficult to think that we're going to go back to a zero because demand for capital and demand for lending is so low that it would necessitate bringing interest rates down to zero to get people to borrow and invest.
I disagree with that position. I think that the global savings glut will continue. You're not going to have a kind of expansion globally in the demand for loanable funds. But the issue you should ask is not the interest rate, but the real interest rate, which is hugely negative right now. And that real interest rate is what drives high price earnings ratios in equities and in homes too. And anybody who's making investments going forward has got to think about what the bond market is going to be providing with regard to not just the nominal, but the real rate of interest. I think it's going to be very low. It's hugely negative right now. And when we get a more normal economy, I think you'll still see the savings glut. I think what happened is that if you think about the River Rouge plant, what that was like, the Ford Motor Company in Detroit versus the Google office building, there's a huge amount of capital involved in that River Rouge activity, but hardly any in the building that Google is located in. So that's a symptom of a new kind of economy that doesn't have the demand for investment funds that we had in the 20th century. But the real issue is, in my mind, is looking backward. That was the industrial age that began maybe 1800. And we're now moving into a post-industrial age, and it's hard as hell to know what's going to happen.
Yeah, if you think about this in terms of the short run, which is the 2 years that we've just presented, and in March we're going to add another year and take it out to 2025, a lot of strength in the economy, hard to see the Fed going to a zero nominal rate. And as Ed just said, that brings the real rate significantly negative. As we look forward through the next 10 years, and this is a debate that we've been having amongst us at the Forecast, there's a huge amount of infrastructure that's going to be built because of climate change, not only here, but throughout the world. And what does that do to capital markets? Is the savings glut so high that we're in a low interest rate environment, which is what Ed was just suggesting, or is this demand for capital such that it takes market rates, real market rates, into the positive territory? Or
is it the governments of the world that are making these investments, funding it by issuing bonds and paper money? Mm-hmm. Rather than increasing savings.
Or cryptocurrency.
Or cryptocurrency.
which is a nice transition to our break. We're going to take a 10-minute break. And so those of you who are here in person, we have more refreshments over here. For our virtual audience, it's time to go to the refrigerator, but be back in 10 minutes. And we're going to talk about central bank digital currency and cryptocurrency. We have a great second part of the program, so we'll see you then. Okay, welcome back, both our in-person audience and our virtual audience. And so now we're going to start the second part of the program, and we're going to be talking about digital currencies. And we're going to lead off with central bank digital currency. Really pleased to have from the IMF Deputy Director Arif Ismail. Arif formerly was head of fintech at South African Reserve Bank. He has deep experience in cryptocurrency and digital currency, and has been working diligently on a project for the IMF to try and understand what the central bank digital currency is. And I think it's not well understood, but I know that Arif does understand it. And so we're inviting him to give a presentation, and then we'll have a discussion about central bank digital currency. That's going to lead into our panel on cryptocurrency. I'm doing really brief introductions because you have the full bios in your packet. And rather than me reading that, I'm going to turn it over to Arif. Arif, thank you for being here with us.
Jerry, thank you so much. And I think the first thing that struck me was just how beautiful the weather is and the people in California. So it's absolutely delightful to be here. Would someone be able to put up the slides for me? Ah, it must be. There we go.
Right there. Yeah.
Fantastic. So most people are absolutely curious about what's going on central bank digital currencies. They are, as I would point out in the slides, probably more than 100 central banks across the world busy on central bank digital currencies. And the question that people are asking is, why? What are they thinking about? What are the drivers? What are the motives? How are they thinking about the design of this particular digital currency? And what could the implications of that be? Would it change our world as we know it in terms of monetary policy, financial stability, banking intermediation, etc.? And over the next 10 or 15 minutes, Jerry tells me I can be quite relaxed. I could talk you through a study that we did that unpacks for about 6 countries in close conversation with them, digging behind the scenes, their thinking on central bank digital currencies. So here we go. As I point out, that there are more than 100 countries at the moment looking at central bank digital currencies. And what's interesting about this is that it's not just clustered in one particular region. You see that there's a multitude of regions across the globe, both advanced economies as well as developing economies looking at central bank digital currencies. So because our membership is so large, we have 190 members, our members are constantly asking us, what can we learn, what can we take out from the work that's being done across the globe? And we went into the study sometime late last year and dug around a bit. And we talked to these 6 countries. We talked to the Bahamas. You'd know that they were probably one of the leading central banks to put out a central bank digital currencies, the Bahamian dollar, the Sand Dollar Project. Canada, who's been in the lead on something called Project Jasper. They've gone through a number of iterations. China, as I would point out for you just now, with a large pilot going on for a number of years. The ECCU, Sweden, and of course Uruguay, who did their pilot a few years ago. So why? What is it that's prompting some of the countries to look at central bank digital currencies? So in the Bahamas, of course, as you would know, getting cash around to the islands is not easy. It's costly. It's cumbersome. They're also prone to have natural disasters. And there were these concerns around the illicit use of money for illicit activities. So Bahama has been one of those countries most interested in looking at central bank digital currencies. The next project that we looked at was, of course, China. And it might be surprising. Why would you think of a digital currency when you have such a high volume of mobile payments through Alipay and Tencent? But of course, there's also financial inclusion challenges. A sizable part of the population still is reliant on cash. And of course, given this plethora of mobile payments, the central bank thinks about what does this mean to have all your digital payments in the hands of private sector. If we turn to Uruguay, the case is very different. The main driver for Uruguay was looking at deepening financial inclusion. A large mass of the population is excluded. And then, of course, if you turn to Canada, it was about what happens, how do you prepare for a world where we would be completely cashless? And the central bank there wants to understand very much their role in this digital universe and in a cashless universe. And of course, Sweden, the oldest central bank, there too, you would go to Sweden, you would see that the ability to make payments is largely digital. You can send payments in a matter of seconds. And again, the big question is, what would happen if you are completely in the hands of private sector for payments? So we picked these countries because they are at different stages. As you can see, some are still in the evaluation phase, like Canada, thinking about both retail CBDC. You can conceptualize that as digital cash issued by the central bank. But they're also thinking about wholesale CBDC, transactions for the securities markets, the capital markets, and how to think of improvements there. Is it possible to have a bond or a security settled in real time, T+0, as opposed to today's world where it might be delayed settlement over a number of days? And could you automate some of these processes, the back office processes? Could you build in the rules into the money and have programmable money? Sweden, of course, was triggered by a government inquiry, and they're still in a proof of concept, thinking very deeply about the legal aspects and the regulatory and compliance aspects of CBDC. China has 260 million users at present in a pilot across many provinces. The ECCU were in a pilot very similar to Uruguay and ongoing, and the Bahamas we know are live. But of course, the challenges related to adoption has been quite significant. And that's an interesting area of work. Why is it that you could have access to a safe, seemingly risk-free asset? Why would there not be adoption? So what are the drivers? And here you would see that we've put out a number of drivers. Financial inclusion, of course, deepening access to the payment system, improving the efficiency of your payment systems, decreasing the cost of transactions, wouldn't that be nice? Improving the speed of transactions between parties, strengthening financial integrity, and of course, many of these payment systems are built on new architecture, a distributed ledger technology, as an example, which could strengthen the resilience of a payment system. And then, of course, sometimes, as I would point out just now, some countries, very few, think about issuing central bank digital currencies in order to protect their sovereignty, to keep their money safe from things, as you pointed out, Jerry, like crypto assets, and of course, deepening competition. So where do these different countries stand? What are the drivers? As you would see, that the reasons are quite mixed. The largest set of reasons is often around efficiency of payment systems, resilience of payment systems. But across, you would see that there's a number of countries that tick almost all the boxes, like China. So the question then is, what is the architecture? And I'll very quickly go through three conceptual models. The first one is what we call unilateral CBDC. And this is a central bank issuing directly to the public. You do not need to go through an intermediary, a bank or a fintech firm or any other entity. And the question is, why would a central bank do that? What would the benefits be? Would there be decreases, significant decreases in cost? The second model is what we call intermediated CBDC. And this is a model that partners with banks, with fintech firms, brings them into the fold in terms of issuing these particular assets. And then, of course, there's one that's called synthetic CBDC, issued by the central bank, but backed through, used as reserves for the means of others to issue other forms of assets. So you would have heard of a company called Finality. They have a sub-ledger account with the Bank of England. They back up their issuance of wholesale tokens with these CBDCs, but they issue their own form of wholesale money. And which model predominates? It's the intermediated CBDC. That's the one that comes out for almost all the cases. And the reasons for that are pretty straightforward. Central banks are not geared to deal with the public for many, many reasons. Taking them on in terms of consumers, dealing with financial integrity, AML, CFT-related issues, and then just knowing how retail payments needs to be structured, marketed, and work. This is not the domain of central banks, and we see for a number of the models that it's the second model that predominates. So where in the value chain then do you see the central bank play a strong role versus private sector? So we've broken this up. We've broken this up into a number of pieces of the value chain. So the liability, of course, the issuance of the CBDC is for each of these models only issued by the central bank. And that makes a lot of sense. And the reason for that is you want to make sure that if you issue $10, then there's only $10 in the network. And for each of these central banks, this is what we see. The second is the validation. And this is the mechanism during the processing of the transactions. How do you ensure that the transactions are processed, finalized, settled? And we see here that there's a mixture between public and private sector. But when you look at the right-hand side, you see very quickly that private sector starts to become the predominant entity to issue wallets, manage the distribution of the CBDC, and manage the customer interface with the general public. But there are two features that stand out from all of these pilots that we dug into. The first is zero interest rates. There are no interest rates on this particular instrument. And the reason for that is that, as you see in the previous slides, that the predominant reason for issuing these assets is for payment purposes. It is not for the management of monetary policy. And then there are limits that are applied at different levels. And I'll talk through this very quickly. So you would see that for many of these countries, there are trade-offs between these different policy goals. There's a trade-off between bringing more and more people into the payment system from a financial inclusion perspective. But of course, there's a trade-off between that and ensuring financial stability. Just imagine for a second that you have an instrument that is very cheap, very fast, very effective, issued by the central bank. Would you still keep your funds in a bank account, in a savings account, etc., or would you prefer to move that to the central bank? And how does the central bank then think about this trade-off between bringing people into the payment system whilst protecting and safeguarding financial stability? And at the same time, to use another example, how do you do that by bringing more and more people, especially for emerging market economies, into the payments network, whilst making sure that the requirements to enter that network are low? As an example, I come from South Africa. Many people do not have access to identity documents or documents that prove where they reside. How do you allow for those people to come into the payments network whilst at the same time safeguarding financial integrity, etc.? So the way that these central banks have thought about doing this, almost in all cases, is by using tiered wallets. You can come in, your requirements would be very low if you do not have, let's say, a document that proves your residency, and you would get a tiered wallet that allows you to transact for, let's say, $200. But as you decide to transact for deeper and a variety of different use cases, the limits would increase. So I'll conclude, Jerry, by saying, what does this take? We've seen across the central banks that it takes deep capacity to build this. There's a number of open questions that range from the type of business model that would be put out there, many legal issues, thinking about how to go into production. And then, of course, what we learn from all of this is that there are a few principles that are quite important, but there's no one size that fits all. We'll talk about that more in the panel. And of course, we're beginning to help many, many countries in our technical assistance. There are about 50 at the moment that we're providing expertise to. Thanks, Jerry.
Thank you, Arif. So the second part of this, we're going to have a conversation about central bank digital currency because I have a lot of questions.
Right.
And I suspect you do as well. So my first question, I mean, this was fascinating and I learned a lot from it, but suppose the Federal Reserve adopts central bank digital currency for the dollar. Now today, when I go out shopping or go to a restaurant, I pull out a credit card.
Right.
And then at the end of the month, Citibank or whomever it is contacts my bank and is set up on automatic payment and it's paid directly from my bank. How does that change, if at all?
Right, fantastic, Jerry. So it could change. So you go to your bank at the end of the month, and you've set up your, let's say, direct debits or direct credits, etc., and you deal directly with your bank. How would this change, Jerry? So what's fascinating about central bank digital currencies, I think, is the ability to have programmable money. So you could set up your transactions in advance to say, pay Arif, $300 every month for attending a conference in LA.
Oh no, is there a limit to that?
For me, no. You can send any amount of money, Jerry. I don't mind. No, I'm messing around. Would there be limits to that? I suspect the answer to that would be yes. But let me take a step back. I think the reasons why central banks want to issue a central bank digital currency is still an open question. What are the policy drivers? And why is the central bank better placed to do this than commercial banks? And would this disintermediate banking deposits? And what would the impact of that be? Would it have an impact on the credit market as you lose a stable source of funds as a set of commercial banks? And is that what central banks want? I doubt that. So I think in short, Jerry, that perhaps some things would change if it's issued, but the issuance in itself, I think, still has many open questions.
And my second question comes from my travels in China. And as you pointed out, there are tens of millions of people in China who are using digital currency. And in those places, it's often the case that you can't use a credit card.
Right.
You can't use cash. And if you don't have a Chinese bank account, you can't pay for anything.
Right.
And so that is potentially a serious interruption in international trade and international tourism. And you pointed out some of the issues in South Africa with folks who don't have the proper or designated documentation. What are the issues there? Or is that another impediment to central bank digital currency that might keep it from actually happening?
Meaning not to have particular instruments that allow you to access?
Right, so you can imagine, well, you had the Bahamas there.
Right.
So you can imagine you can only use Bahamian currency and only digital currency, and you're a tourist.
I see.
But somehow you've got to go through these costs, which may include establishing an account at a Bahamian bank.
Right.
That's a country that's heavily dependent on tourism. What happens there?
Excellent. So let me use the example of China as best as I understand it. So during the Olympics, Jerry was attending the games in China. And the only instrument that was accepted was the ECNY, the central bank digital currency. How would you do it? How would you get it? Would you need to go to a bank and open an account? And how would you transfer funds into this particular wallet? My understanding is it was very seamless. You download an app, it picks up your geolocator, it knows that you are in a particular province in China, you do an automated upload of your image, and you load up your Visa or MasterCard in order to move funds into the wallet, and Bob's your uncle, you can transact within seconds. When you leave, the funds automatically go back into your Visa and MasterCard account. So pretty seamless, the way that we understand it in terms of how you could acquire the wallet when you're traveling. So for tourists, it should be a breeze, depending on how the design is set up. If it's very intuitive, very seamless, the opportunity is there to use central bank digital currencies.
And that opens the question, why when you arrive in Beijing Capital Airport, you can go to the exchange your dollars for renminbi, and you're off and running. Which one has less cost, right?
Right. So it's probably which one has less cost, which one has greater convenience, which one allows you rewards over time, right? So one of the things we pick up is the ability to couple other transaction sets and not just payment transaction sets. So a friend of mine was saying he was in a rugby game, and he got this message from one of the providers that said, I see you in the game at the moment. We note that you do not have insurance for your cell phone. Would you like to have insurance covered during the game? Insurance on demand. And that's because not just of having access to, let's say, a digital currency, but the ability to have data that's then linked to your profile.
So let's turn to Gresham's law.
Right.
Where bad money drives out good money. In the U.S., we've had, we think about the dollar as the dollar as the dollar.
Right.
But we've had multiple currencies in the past, including the greenbacks that sold at a discount. Is this going to be competing currencies within a country?
Well, I would think yes, from the perspective of thinking of it as central bank digital currencies, which is then issued by the central bank. It's certainly a liability of the central bank. Even if you have these intermediaries that I described, like a commercial bank, the liability still sits with the central bank. I almost think of it as like cash, except in digital form, that the cash, even when you draw it out of the ATM, you may have gotten it from Citibank, but the liability is still of the central bank. So yes, I would think of it as competing sets of money. The trick, I think, is the trade-off that I described. How does the central bank think about ensuring that the current two-tiered banking model structure still remains in place, introduces healthy competition from a payment system perspective, but doesn't disintermediate or disrupt the banking sector from a financial stability perspective?
So we've been talking a lot about inflation today. Let's turn to a country with actually a lot of inflation, Argentina.
Right.
Suppose the US has central bank digital currency, so your currency is on the phone with an app. Why wouldn't Argentinians just go to using the US dollar and drive the Argentine peso out of existence?
I suppose there are two reasons that may not happen. The first is the way that the US would set up central bank digital currencies. Would it be accessible to the Argentinian population? That's a fundamental question in design. And the second is, would you have providers within the Argentinian network who take on your pesos and give you, intermediate the digital currency? I know I'm making it simple, but could that be the case? We see that now with stablecoins, right? People hold on to stablecoins privately issued when you have cases of high inflation. But for central bank digital currencies, I would think differently. I would think that there's a set of principles that have been put down by the G7, and one of them is do no harm. So how do you design this to ensure that currency substitution in other countries are limited?
But isn't it the case that the large countries, so speaking of the EU, UK, US, China, who want to have their currencies as being the international currency and gain seigniorage from it, would not really want to restrict that currency from being used outside of their borders?
Well, I suppose it depends again, Jerry. So what is the policy driver, and how do you think about it, within the context of international reserves, a currency for trading across the globe? How do you think about that?
So that leads to the last question that I have, and then we'll see if we have a couple questions from the audience, which is, how, if this were to occur, and I'm gathering from your presentation and your answers that that's still an open question, how long before we would see central bank digital currency in a big way, not in the Bahamas, but in the US or the EU or Canada, countries that really have been studying it in a serious way. What is the timeline, or is there a timeline?
I think there is a timeline, Jerry, but I'd almost tier it again and say, I think, in my own personal view, the biggest use case for central bank digital currencies is for cross-border payments. We know how slow, opaque, costly these cross-border payments can be for both business transactions as well as for, let's say, remittances for migrant workers, etc. And I think that there's lots of work that's going on there. There's the MCBDC project between a number of central banks called Multiple CBDC by the Bank of Thailand, Hong Kong, UAE, China, and so on. And there's lots of progress there in terms of demonstrating that there could be real value for cross-border transactions. So I think we'll see it tiered. Cross-border transactions is probably the first use case that we'll see in the medium term. In terms of retail CBDC, digital cash, I think it's really, really dependent on the context within each jurisdiction. What would happen now? 260 odd million users in China. Would we see the shift towards CBDC there, ECNY versus Alipay and WeChat Pay? I'm unsure. And the reason why I'm unsure is that the value proposition that you have from these super apps is incredible. You can do, it's more than just making a payment, right? It's booking your ride. In one app, it's visiting the dentist. It's a range of things. So CBDC will have to compete with those value propositions. It has to offer at least a minimum, a minimum product that matches what's in the market. So in terms of timing, I think again it's more longer term, and what that is, I don't know.
Yeah, so maybe an interesting idea that might not ever happen.
Possibly.
So do we have questions from the audience? Yes.
So the current financial intermediate system is the central bank issue is a monetary base, and through the banking's fractional reserve banking system, we had this money multiplier, and then we create
Right.
supply 1, 2. So how does this CBDC impact this kind of currency system?
So yeah, let me repeat the question. So the current system is the central bank creates monetary base, which then the banks, through the money multiplier, increases the supply of money in a country and facilitates transactions. How does that work if you have central bank digital currency?
So I think if the replacement of the replacement of particular payment instruments by CBDC, let me use some examples. If it's just a replacement of cash, then what you describe remains exactly as it is, right? If it's a replacement of banking deposits, I think we then start to see the impact that you describe, right? Banks having to source funding liabilities, from perhaps the money markets, etc. And what would that then do for credit intermediation? Would we even see, transactions in the money markets shift? And if that's the case, I think your scenario would have a larger impact on the multiplier. But again, it's dependent on the design, I think, of CBDC. But a great question. Thanks.
Okay, do we, Ed?
So when I hear the word currency, I think of two functions. One is store value, and the second is
Medium of exchange. Right.
And Jerry has already indicated that most of our transactions are digital now, either because crypto is offering anything new with regard to means of transaction. The critical issue is whether it's a store of value. That's sort of what
Right.
William was asking. Do you think that the private market has clearly demonstrated the store of value isn't done very well with crypto? But is it your view that the store of value will work well when it's issued by monetary authorities?
Well, it's dependent on on the credibility of your monetary policy framework, right? It's the same liability. So I think it's dependent on that, Ed. If you have a poor regime, poor institutions, poor monetary policy framework, then issuing a central bank digital currency isn't going to change that. That's the starting point, right? Robust macroeconomic policies, monetary policies is the first line of design, if I could put it that way.
Yeah, so if you're Argentina, maybe not. If you're the US, maybe so. David. Did you have a question, David?
I can ask a question. So the Federal Reserve's proposal was about having central bank digital currency where it would be a liability on the Fed's balance sheet, not at the local financial institution, community financial institution, or wholesale financial institution. So obviously large disruptor. What ethical research has been done in this area about the effects downstream and elimination of current credit markets and financial institutions?
Oh, I think there's lots that's been researched on this. And the conclusions are often, those two pieces that I very quickly pointed out, that, zero interest rate, you want to make sure that as you put out this particular instrument that you're not competing with deposits unless you want to discipline the market, right? If you start to increase interest rates, then I think the likelihood of seeing shifts from the deposit base to CBDC might be larger. In times of crisis, that might be even more prominent. You might see rapid runs, from deposit base to CBDC. So I think there's lots of work that's happened in that space under what you're calling ethical. I would just phrase it differently and say the financial stability implications are top of mind for central banks as they think about central bank digital currencies. Yes.
And so you think about the privacy in consumer data, and then ultimately, that could downstream perhaps with compensation or something to the consumer for sharing the data, but in this case, it's forced. So has that been discussed as far as that?
Yes, absolutely. I think the data protection frameworks are quite fundamental. It's a significant part of the design. How do you ensure that the data that is captured is private and secure, and that even if you have it as a central bank or in inverted commas government, you ensure the protection of that data. The data though is where the biggest benefits could be for consumers, right? But how to manage that data, how to make sure that you use it only on consent of the consumer, and in many frameworks, the right to forget and disconnect from that data should still lie with the consumer. So those are fundamental aspects of the design.
Yeah, so that may be the largest hurdle to the adoption of central bank digital currency, but non-central bank digital currency is in existence today. So let's turn to that, and let me invite our panelists up. And we'll talk about cryptocurrency, which is specifically designed not to be governmental. Okay, so we have two additional panelists here. And what I want to do is start with, again, a very brief introduction, and then we will move on to a discussion amongst our panelists and with you all. And so let me get the questions that I have out here. Okay, we're ready to go. And we're going to begin on my immediate right. We have David Wax. David is Senior Director leading EY's Strategy and Transactions Digital Asset Solution Team. That doesn't really fit on a business card. That's a long title.
It's all on a token. Don't worry about it.
Excellent.
In this
passion.
role, David has spent the past 2 years aiding in the delivery of various digital asset engagements, including commercial due diligence, market entry strategies, product strategies, and operational risk control design efforts. And please, the bios of our distinguished speakers, look at their bios, but let's just dive in. And so we talked about the why of central bank digital currency, but what about cryptocurrency? What was missing in the financial environment that led to the development of this new asset class? And what's needed to allow this asset class to kind of cross the chasm of adoption?
Sure. So thanks for the question. Thanks for the invite. So I think it's really important to define cryptocurrency real quick, right? So when we're talking about it right now, and I'll do it in a certain way because I think it's more fun. So let's strip out CDBC. Let's not talk about that. Happy to talk about it later. You just talked about it. It's interesting. Let's strip out digital representation of either physical or existing financial assets. Also an interesting topic. Happy to talk about it. That's a question about T0 and liquidity and other things. We can get into it. Then what are we left with? We're left with base payment systems. So that's Bitcoin, Ethereum, Poly, right? All the sort of base layer transactions that are used for payments within those blockchains and or staking or security within those blockchains and return. And we're left with utility and governance tokens. So Uni, Comp, Aave, tokens that are, I won't get into whether they're securities or not, but represent forms of ownership rights in certain ways of these smart contracts. So if we limit our scope there, because it's more fun to have this answer then basically we have to go back to the past to predict the future and talk about the chasm, right? So if we go back to the past, it's really important to understand Bitcoin is the past, 2009, it's what was the invention, and that was created to remove intermediaries, right, from the need for centralization and intermediaries in the idea of, as you said, the store of value in transactions. That was its purpose. You can read the white paper, you can debate it a little bit, but give or take, that's its purpose. Really important to understand. That's what this thing was built to do. It wasn't built to increase transaction speed. It wasn't built to get to T+0. It was built to do that, right? That's its use case, right? So if we then sort of, pull that, forward and we say, okay, that was Bitcoin, and then you say, okay, well, what about Ethereum? What about smart contracts? What about all that? Fair enough, innovation on top of Bitcoin, but really that's just the same thing. That's just adding logic, right, to now the store of value and transactions, smart contracts, right? And then it's adding a whole bunch of other capabilities with governance tokens, right, in terms of voting and things like that, right? So at the end of the day, what it really means is that it's the whole concept of it is to try and remove centralization and remove the need for intermediaries in this transaction, right? And so as I look forward to try and now go from the past to the future, right, and think about, okay, what does that mean? So to me, there's going to be a push and a pull. And actually, I was really impressed by your analysis. And I was watching it. And the push part is going to be in terms of the future of cryptocurrency is going to be the level of trust that we have in central entities, right? It was created because we lost that trust in 2000. Satoshi lost that, or a group of people who are called Satoshi, lost that trust in 2008, right? And it will, and so that's why they created this technology. And so if we continue to lose trust, if there's a massive recession and you guys were all wrong, or you go off the Volcker curve and whatever happens, probably people will lose trust and probably demand for this currency will increase, right? And just before I get into the pull part, the other thing to understand, and it's really important to understand, this is not going away, and I can prove it. I can't prove it. I can predict it, because as of this morning, people were still willing to pay $16,900 for a Bitcoin and $1,200 for an Ethereum. After FTX's collapse, after all the fraud, after all the smart contract stealing, after all of this stuff, right? People are still willing to pay that because there is a group of people who are interested in having non-centralized currencies for whatever reason. There's many reasons around the globe, and we can get into those. And then the last piece, I'll turn it to more questions to other people, is really the pull part of this, and that gets into what you were talking about a little bit. The wallet and the experience of this is terrible, straight up terrible, right? Because its use case wasn't that. It wasn't to solve a better user experience, it was to remove the centralized entity. And so on the pull side, whether it is wallets like MetaMask or Coinbase Wallet, whether it is more sophisticated firms like JP Morgan and others, you know, I shouldn't say more sophisticated, more entrenched firms, you know, that's going to be the other side of this, right? You can get the push, right? We could have a terrible recession. We could have a government that no one believes in. We could have all that push. But without the pull there as well, like you can actually use this stuff without being a programmer like myself, then, you know, you won't have it. So you need both, is my answer to what you need to cross the chasm. Does that make any sense? Well,
Sure. So let me turn to our third panelist, and I promised Nikki that I would not try to pronounce anything in Portuguese with a bad Spanish accent. So our third panelist is Nicole Discant, and Nikki has 20 years of practical experience, currently serves as Global Head of Legal and Compliance at Hashdex, which is the largest LATM crypto investment advisor. And prior to that, she had her own legal firm in Brazil, years and years or decades of experience in the legal landscape internationally. And so let's turn to that. There's a lot of talk about regulation of cryptocurrency. But as David described, the whole idea was to get government out of it. Now government's kind of coming back into that. And what does that look like? What is the landscape today as we think about this across borders?
Hello, everyone. Is it working?
you have to turn it,
Yeah.
yeah, okay.
Such a pleasure to be here. Thank you so much for the invitation, Jerry and Leo. I'm very happy to be back in the university and in this beautiful day, so I'm very happy. Thank you so much. Thank you, my fellow panelists, too. Yeah, and well, first let me say that I completely agree with David and Arif's vision. I think by now we can all agree that Bitcoin has failed to be this peer-to-peer payment method that would prescind the intermediary role and the trust role in the payment infrastructure. I think the crypto infrastructure, as much as it was originally thought, the philosophy was to be very decentralized by nature, it ended up being very centralized. So in the hands of a few players called the VASPs, the virtual asset service providers. So I'm mainly talking about the exchanges. They call them exchanges, but there are more brokers than exchanges, right? Because there's no central counterparty and DVP. So let's think about the VASPs again. So exchange, OTCs, custodians, wallets. These guys, the service providers, very few players dominated this market, and unregulated, unsupervised. Unfortunately, their lack of controls and risk management, and of course, greedy. So we are now facing the whole market, facing the effects of their greediness, and because it's a very immature and new market, all these factors are affecting the good actors too. So, for example, Hashdex, how can we survive in an environment like this? So since the beginning, we actively looked for regulated providers. So some of these providers go to, for example, New York Financial Authority. The BIT license is a very strong license. So Coinbase, for example, is regulated. One of their entities is regulated. We have a lot of other examples in Singapore, Hong Kong, Japan, of regulated entities providing the services. So before investing in trading in an exchange like this, we actively look for the license, for the whole group. We conduct a very robust due diligence. So Leo yesterday was talking to me and asking, how can we prescind this intermediary role and still be comfortable putting our digital assets in the hands of these providers? And I told him, doing due diligence, the same thing we do for banks and we do for brokers. So we have a due diligence robust list that we look for the whole group, for if it's a clean shop, if there's any sanction against this provider, the whole policies and procedures, business continuity plans, cybersecurity policies. So all the diligence that you normally do in the TradFi, the traditional financial market, we do the same thing for the digital assets providers that we work with. So, so I think my first takeaway here to summarize this is CeFi, the centralized providers, need regulation ASAP. And not only regulation, supervision and enforcement too. Otherwise, I think the lack of trust will increase. It's impossible to think more after this FTX event. So I think we are, but I totally agree with David that still we have the blockchain is much more than the Bitcoin, and all the, and we can talk a little bit about DeFi as well. You know, the decentralized finance, the protocols that are completely open source, permissionless, and smart contracts that are auto-executable. And they are not suffering with this crisis. Of course, they have their own problems, the user experience, the lack of a human that you can talk and say, hey, listen, I forgot my password. So some of the people are still looking for CeFi, and that's why we came in this centralized environment for crypto. But the DeFi solution are proving itself very interesting for a collateral management perspective, DVP, this delivery versus payment that we cannot find in the centralization crypto asset world. But in DeFi, we have some projects, and some projects already mixing and matching the DeFi's benefits, which is the good technology, with controls, which are the permissionable networks that we are studying some projects. So, for example, I am part of the innovation lab in Brazil with the Brazilian Central Bank and the Brazilian SEC. And we are studying a very nice use case with our commercial banks being the validators of this network, using DeFi technology, but with AML, know your client control. So the banks are validators, and the banks, each one of the banks will have its own stable coin that will work in this network. And hopefully this will be, you know, I'm very bullish of this solution because I think we can have the benefits of having, you know, tokenized and everything in digital, but with controls that we cannot present in the completely DeFi world.
So this is for the whole panel.
I'm sorry about that.
No,
But,
go ahead.
Opacity is one of the characteristics of cryptocurrency, you know, the ability to, for example, evade capital controls if you want to move money across borders, you know, whether they are mild capital controls or simply informational ones, or strict capital controls. So opacity seems to be one of the characteristics that that cryptocurrency attempts to solve. When you have regulation, the whole idea of regulation is to eliminate in some way that opacity, whether it's to the user or to the regulator. What does that mean for the future demand for this kind of digital asset?
You can start.
Yeah, no, I think it's a very interesting topic, Jerry, and I think the whole industry is kind of trying to figure this out. And of course, you know, the regulatory arbitrage that exists in the TradFi and exists as, you know, as a weapon that people use. For example, in the beginning of Bitcoin, people used to make a lot of money just, you know, buying Bitcoin in the US and selling in Japan. So it's the same thing with regulation, right? If you remember this time,
That's what Sam did.
Unfortunately, I wasn't into crypto back then, but I've heard some of my friends make like huge amount of dollars. But in the regulatory side, it's kind of the same thing. So people try to look and see where is the best place for them to trade. So for example, we do the reverse thing. We actually look for where is the more robust regulation to trade. But of course, some what we call pirates, they do business all over the world, and they are based in a country that there's no regulation. I won't cite names, but I think you can think about like the biggest exchanges that do this kind of stuff. So what I think we are coming right now, especially after FTX and Celsius and all those insolvencies cases that we just had this year, we are coming together for more regulation around the globe. So each country is studying, as you mentioned, like there's some I think 100 central banks studying CBDC, a lot of people studying VASP's regulation. Brazil just passed last week, a regulation for VASPs. So, but I take your point that it's local, and again, we will have an issue of internationalization since crypto has no borders. But I think the importance of the international regulatory bodies like OECD, FATF, the Financial Action International Force, the World Economic Forum, the BIS, the Bank of International Bank of Settlements, IOSCO, which is the SECs of the SEC, they coordinate. So all of these bodies, they are thinking together and issuing reports and papers about the risks and how to mitigate. And I think that's going to be very important for us. And I think a good example of a regulation that tried to playing this level to playing this level of this field is MICA in Europe, that is trying to put all the state members in the same position to avoid arbitrage between the countries. And I think Europe, as they did in GDPR, they are trying to settle an example. It's a very robust piece of regulation, much more than only the VASPs. So they try to regulate each category of tokens, so utility, payment, e-money, which is the stable coins. So they are with different levels of regulation. So I think it's a good example what they are trying to do in Europe. And everyone that want to trade digital assets in Europe will have to follow this in 2024. So we are now in this period for adoption, which will take a lot of work for people that want to comply with this rule. So I think probably this will be a good example for the rest of the world to try to follow.
Go ahead, Dan.
Just real quick on opacity, because I think it's important to understand. The transactions are not opaque, right? So if you're a person who likes to track transactions, this is much easier than any other form of currency that I'm aware of personally, right? It is globally trackable. If you told me your public address, I could find every transaction you've ever done in less than 10 seconds. That is true. The opacity comes in the user, right? So the wallets and the fact that they are opaque because that's how it was designed. And so there are a number of entities, bodies, technology companies, even DeFi with Aave and what it's doing, that are trying to solve that, right? So it's really, to me, opacity is really about AML KYC and not about the actual following of the transaction. It's actually, when you talk to most FBI agents or others, it's much easier to follow the trail with this than any other currency. They actually enjoy it, from what I've discussed with them.
So there is a narrative that the cryptocurrency is used to move both illegal money and to get around capital controls. But if you can track it so easily, then why would this be attractive?
Because you can do it without signing up into a bank, right? So I can go get a wallet, I can download MetaMask, I can go do it, I can go hit up Uniswap, and I can go trade this stuff all around the world without ever disclosing any information about myself or who I am or my entity, right? I can do that today. And there's no other place you can do that except for cash or gold or current commodities or other things.
So the transaction can be traced, but not necessarily the owner of the transaction.
Right. In those systems. In other systems that you have to go through AML, KYC, they can track it.
So if you have more regulation, does that go away, and does that really reduce the demand for this kind of asset, or are there other characteristics that make cryptocurrency an important new asset class?
Weigh in.
Let me weigh in. So I hear David in terms of the desire to not have intermediaries, the ability to transact, to track and trace, and I hear the case for stronger regulation. And I go back to Ed's point about the essence of money, right? If you want to have a great store of value and a medium of exchange, then surely regulation is what gets you there. opacity is not going to get you there, right? And we know that for some of the crypto assets, you can have techniques, and it all sounds fancy, mixers and tumblers and so on, to ensure that the anonymity remains. So whereas you can track the transaction, in those cases it's even difficult, right? You can track the transaction, but to link it back to the individual is extremely difficult. My sense of it is that regulation's coming. We see that in the examples that you use, MiCA and all the bodies that you mentioned, it's coming. And I think if we take the macro view, that if we want to ensure that the impact on the international monetary system, as these transactions become more and more present, more and more prolific, then we must make sure that the international monetary system stays stable and sound. And therefore, I would argue that opacity is not the name of the game. Transparency is the name of the game, whilst protecting individuals' privacy. But let me pause there.
And I just want to add to answer your question of if you introduce centralization and regulation, would you lose the asset class, right? And so I think the answer is we'll see, right? So it was designed, right, to remove intermediaries. While introducing regulation will introduce intermediaries in some way, shape, or form. And it was designed to be anonymous, right? And so obviously regulation will end that as well. So its original design intent will be destroyed. So the question is, are there other facets of this technology that are strong enough to overcome that destruction, right? And the argument today is maybe, but the ones who make the argument to yes is, sort of your T0 settlement piece, right? That you can actually settle, right, these things faster. The lack of friction between global payments, which is really just a removal of intermediaries, by the way. So it's very good at that, actually. And then, some other things around programmability and controls and all that kind of stuff you can do with smart contracts. So that's yet to be seen. Like, that's the interesting question. When regulation comes, which I agree will, and it removes those initial use cases, is it then still a technology that's better than the decentralized databases that we have today, right? And that's what, all the people who are spending all the money researching this are trying to figure out. I don't have an answer.
And I guess the follow-on would be, suppose you have that regulation. Not every country wants to follow that. And you can think of maybe Cayman Islands and others of like mind. Do you have a new cryptocurrency starting in these locations with that kind of characteristic, the one that's lost with regulation?
Competitive. Personally, I don't think you would see a centralized government cryptocurrency standing up to fight that.
Right.
I think you would see these existing platforms that are decentralized, like Bitcoin and Ethereum, as the competitor to centralization, right? Which is really what they are at the end of the day. They are literally competitors to centralized fiat, right? And so you need to view them that way, and who wins that battle, we'll see. I mean, I think it's centralized fiat, but we'll see.
Yeah, and Arif, you talked about as these cryptocurrencies become more prevalent, the IMF is thinking about how do you meet your charter to smooth out fluctuations in international capital markets. What are the issues there?
Yeah, thank you. I just want to go back to something David pointed out. So sustainability I buy what you were saying earlier on about the potential for other products to emerge, right? Maybe crypto, I don't know, 2.0, 3.0, whatever one wants to call it. But the ability to see tokenized assets like property or mining rights or carbon credits, we've never had that before. So the potential to move beyond just money lies there. And I think we're seeing more and more innovation happen in that space, tokenized assets, right? The ability to fractionalize. I'd love to own art, expensive art, but the ability to buy it now, for pieces of it would make a lot of sense. Going back to the question on how do we see the overarching framework in the IMF, I'm happy to say that we're very close as the IMF to produce a paper that we call the 9 elements of highly effective crypto policies. And you can think of these 9 elements across 3 dimensions. So often when authorities, the ones that you mentioned, are thinking about crypto, rightfully so, we go for the middle layer, and I'll describe it now, all about regulation, licensing the VASPs and the exchanges and the wallet providers and so on. As the IMF, we're forced to take a step back and say, well, how do we think about this more holistically? So the first dimension, I'll capture it very briefly, is really about macro considerations. How do you safeguard monetary policy and sovereignty? How do you ensure you don't issue crypto as legal tender and grant it official currency, right? That's element 1. Then how do you think about the impact on fiscal policy and tax laws and so on? And how do you think about, as you mentioned, Jerry, capital flows and ensuring that there's safeguards for capital flow management measures? That's tier 1, if I call it. Tier 2 would then be about the legal framework, regulatory framework, licensing, and the collaboration, with domestic regulators. That's tier 2. And tier 3 would then be about how do you address the extraterritorial nature of crypto assets? And Cayman Islands is an example that you use. How do you negotiate with the other regulators to create what you've got for MiCA? A consistent, I think you called it level playing field, right? That's tier 3, including the IMF, together with other standard-setting bodies, monitoring the international monetary system for changes in global reserves, impact on currency substitution, impact on capital flows. And then the last piece to the puzzle, which is the 9th element, is how do we not only, as a collective community, just have what I would call a defensive strategy, right? Just regulate. How do you also start thinking about what David was mentioning, leveraging the technology, right, for other use cases to come? And I'll position again quickly that I think that the 9th element is really about strengthening cross-border payments. And it doesn't matter what it is, whether it's stable coins or CBDCs or some other form, right? Interlinking faster payment systems. This is where the magic lies, I think, in cross-border payments. So that's how we're thinking about it across these 3 dimensions and 9 elements, and it should be out in the next 2 months or so.
Okay, we look forward to that. Do we have questions? Yes.
As a banker, this is all Greek to me as a banker. But the amount of fraud that occurs in the banking system today is epic. I mean, our clients, pretty much every single week, we have one of our clients have some sort of fraud. There are people sitting out there in foreign countries spending all day long figuring out how to get into, our database, our company's, databases, and they ACH money out, they wire money out, they take over accounts, literally every week. How is, cryptocurrency going to prevent that? I mean, if it's all online, there are going to be people sitting in North Korea, in a room trying to figure out how they get into that database and steal everything that's in it.
I have points of view, but do you guys want to start?
Please, David.
So I think you have to separate it. I think in today's world, when you use, what's known as DeFi or these smart contracts, it has a lot of problems, and it doesn't solve tremendously the problem that you're talking about. Where I think cryptocurrencies does, or the blockchain technology along with wallets, does solve the account hacking problem really well. It is almost impossible to hack. I mean, it is impossible to steal someone's private key. That's true, right? So the theft and that type of cyber and or physical theft is possible, although there's a lot of ways to protect against it. So I think that strengthens or can be strengthened with this technology. I think the hacking into the basically exchange, if you can think about it that way, is not fully worked out at all. And I think regulation and some more sophistication will help that out a lot, right? And I think they can solve for it. So I don't know if that helps with your answer, but that's how I would view it.
I don't believe it, frankly.
Yeah.
To be honest, the amount of fraud and the sophistication of the hacks and the information that they get, it's unbelievable. I mean, I can tell you stories for hours about companies who have had their email of the CEO hacked, and they send an wire $1 million to this account for me. I'm buying real estate somewhere, and it's perfect. It's absolutely perfect.
Just to add here, because I think there's a difference between the fraud, the on-chain fraud and the out-of-chain. So this kind of fraud, I think it's like the phishing part and the crypto parameters, and it helps out. It happens a lot as well, but it's mostly like human wrongdoing and not like hacking the blockchain itself.
Right.
Yeah.
It
So it's
would be
kind of
very
the same
difficult to do
in
that.
terms of like people doing this kind of fraud. And in crypto with digital currency, at least in Brazil and Latin America, we see it a lot. For example, our rule, the law that we just passed, brings a specific crime that it's like just going against this type of crypto pyramids, pyramids, right?
Pyramids? Yeah.
And we didn't need this crime because we had like a generical fraud manipulation that would cover that, but because it's so high on that type of crime, we put like this specific crime for people to see and try to disincentivize and maybe prevent the lawyering defenses against it. But it's there because of this is giant down in Brazil. Unfortunately.
And so that's to prevent something like FTX.
If you consider that like a Ponzi scheme, yes, let's see. I agree. It seems like it was fraud. But I'm talking more about this kind of stuff that he mentioned, like people trying to steal money, like saying that it's like a regulated business and put your money here, then you're going to receive XYZ in terms of interest rate. And it's just like a Ponzi scheme, a pyramid.
Okay, do we have other questions? Ed?
I heard the word token, I think you said that. That brings to my mind these NFTs that have had incredible sales, a piece of art, because they are associated with blockchain records of the transactions. And so I'm wondering whether that market worries you, cast any shadow on the Bitcoin, or if you want to name three things: NFTs, beanie babies, and tulips. Do you have to worry about any of those?
I only buy digital tulips, so it's that was a lot. So yes, of course, there has been a bubble and speculation going on in all of these markets, right? There's, I think there's a book called Boom and Bust out there. I'll do a little plug. Great book, by the way. History is all the bubbles throughout, starting with, I think, the tulip bubble. But look, there was especially in NFTs, this massive bubble around speculation, which was driven by immense amount of liquidity and a lot of people having a lot of time on their hands because they had nothing to do because you were sitting at home staring at a screen. 100% happened. It did happen, obviously. But underneath all this are sort of interesting innovations that, again, are because of the technology and the communication levels that we have now. You need to understand, right? There was no internet in 1994. There was no social media in 2000, right? The speed at which this technology is able to grow is unbelievably fast. And sometimes it grows faster than its use case. And that's what happened, right? But the question of, can you take an NFT and build a viable use case? I can come up with a few, right? They're just very different than Beanie Babies, right? Like Ticketmaster and what they're doing, and Yellow Heart, what they're doing around ticket sales. Really interesting use case for NFTs, right? These concepts of soul-bound NFTs, right? So this idea that you can never trade it, you can never move it, right? It's just yours, and it's like almost like a social security card, if you will. You can do a lot of really interesting things with that. So it just needs time to work itself out. Because of the speed of technology and communication, these things just move beyond themselves, in my opinion. And so interesting technology, interesting thing. Yes, it was a bubble. We'll see what utility comes out next. Don't know.
Okay, we have two other questions over here. Go ahead, first question.
Thanks. I'm a bit afield as a demographer, but kind of reflecting on the title of the panel, Future of Cryptocurrencies. I'm curious, David in particular, you kind of led off by saying that these aren't going away and pointed to the $16,900 price of Bitcoin as evidence that all of these other individuals, entities, actors are still interested. But then you drew a sharp distinction between the original use
Tokenization.
such as cross-border or whatever.
Yep.
So is the incentive of these, every individual actor and everything in your view, these kind of new incipient use cases and the potential windfall from that, or is it something else?
In terms of the future of it? Yeah. I think it sort of starts to hit equilibrium pretty soon. So there are plenty of use cases and plenty of people who want decentralized currency for various reasons. We can just use a simple one. You're in a country where you cannot trust your government and they can literally steal your money, right? Like there are cases of that, and Bitcoin is a use case for that, right? It's just not a universal problem. Universal problem is when you ask 10 people around the globe randomly, 9 out of them say, I absolutely need that, right? Like the internet was a universal problem. It's not that, and it will hit equilibrium, and it will flow based on that push. How much do we trust our centralized governments, banks, other people, and how much do we not, right? In terms of the new use cases, it just comes down to, are those advantages that blockchain has really advantageous, right? So I've talked with a client of ours about equity, US equities, right? And using those on a blockchain. And this is a big infrastructure player. And their point of view is right now, no, there's no advantage because it's unbelievably efficient, right? I mean, again, there are inefficiencies. I understand T+2, all that stuff, right? But their answer is no. But in the case of private credit, private equity, illiquid markets that don't have, strong issuance properties, they don't have great transparency, there is no liquidity on the secondary market, literally no liquidity. Yeah, I think it's got tremendous advantages, right? So I think it's asset class by asset class, and then eventually the technology may evolve to take over really efficient stuff.
Yeah, go ahead, Nikki.
I'm also very bullish on the tokenization of real assets.
Yep, another good example.
And the ability to share like small pieces that today is impossible. You cannot buy because it's inefficient, it's not cost effective. You buy a fraction of an Apple share and put as collateral of a fraction of a real estate assets in New York. So that's we are not there yet, but I think we will be there by some point. I don't have a crystal ball here, but maybe the 3 or 5 years. Today, the tokenization is not very, some of projects that started because, there are still in sandboxes, so there are some legal issues too. But the study and the technology behind, I'm really bullish on that. What about you guys? Do you agree?
Yeah, similarly, I know the topic's cryptocurrencies, but if I think of the power of the technology and, as David was saying, the speed at which it's evolving, then for cross-border payments in particular, and not linked to CBDCs, I think I'll just couch it as multilateral platforms is potentially what I think will emerge in this space. So the ability to see central bank or commercial bank money tokenized and easily transferred across borders within multilateral platforms that solves for liquidity issues, contractual issues, greater transparency. I think we'll see
finance,
that.
right?
Access to finance, yeah.
It's also a real deal.
Yeah, and just to give an example of countries where you don't trust the government with issuing money, Myanmar, formerly Burma, 5 times since gaining independence, has completely trashed the currency by saying to their population, you have this currency, it's no longer honored. We're going to issue new currency, but we're not going to trade in the old currency. So in Myanmar, people rely on Norwegian telecom if they want a store of value. And we have our last question.
Yeah, this is a sort of a policy question here. If labeling a phenomenon is important to give it both legitimacy and credibility, is the word crypto the appropriate title for this currency? Because I looked up the definition of crypto, and it said, first of all, cryptography. But the second definition said it's about a person having secret allegiance to political creed. So I'm wondering, if you were to rename this phenomenon, what would you call it?
I'd give you a hashtag for it.
The prevailing industry term for that is digital assets.
I would say that.
That is what most large banks who are working in this area now refer to this area for the exact reason you're saying, by the way. They want to distance themselves from that name. Now they want to distance themselves from other, sort of issues that are going on. So digital assets is the way that they're referring to it, which is a decent name.
Yeah, so Nikki, Arif, David, thank you so much for being here.
Thank you.
I've learned a tremendous amount, including learned how little I know in this area, but now I have at least the basis to go and learn more.
We all know very little. We all know. We're
Yeah,
just
so
trying
thank you
to-
very much. This is going to bring our program for this morning to a conclusion. Before you leave, two announcements. One is our next conference is in March, and we're going to be looking at the change in the business of healthcare post-COVID. If you remember back on my charts of the sectors that have been growing, healthcare and social services was one of the fastest sectors, and there's a lot of really interesting innovations there that have implications for insurance and as well as for the delivery of medical care. And then the second and final announcement is, again, we could not do these programs without our sponsors, and I want to quickly thank them once again because they're so important for us and the research and programs that we do at the Anderson Forecast. Our principal sponsor is RSM today. Our platinum sponsors, the law firm of Allen Matkins, Cafe Bank, Clark Construction, Leap Development, and University Credit Union. And then, it's on the next page. Coming up, pages are sticking together. At the gold level, our sponsors are Avenue Insights Analytics, Bank of California, California Bank and Trust, California Steel Industries, Venture Forward by GoDaddy, Pacific Western Bank, Robert Half, and United Airlines. At the silver level, Hathaway Dinwiddie, Scottwork North America, Union Bank, the private bank, and Valley Bank. At the bronze level, Dub Value Creation, EY, HDR, Hanmi Bank, InstaWork, and Marsh McClellan Agency. Our Bruin sponsor today is Gerber Kawasaki Wealth Investment and Management, and our academic sponsors, UCLA Extension. Thank you so much for being here, both our in-person audience and our virtual audience. We will see you in March.